December 19th, mark the date, because this could be the moment global markets tip into a self-feeding death spiral. You're probably asking, why that specific day? Because there is now a 98% probability that the Bank of Japan hikes interest rates again, and that single decision threatens to accelerate the most dangerous trade in global markets today. The yen carry trade unwind. If that sounds theoretical, let me ground it in reality. Go back to August. One surprise 25 basis point hike by the Bank of Japan triggered a 12% collapse in the Nikkei in one trading day, 20% collapse in Bitcoin, global equities selling off together, and violent, disorderly moves in currency markets. That wasn't a fluke. That was a stress test, and markets barely survived it. Now, here's the part almost nobody is talking about, and this is the real bombshell. This time, it's not just rate hikes. The Bank of Japan has also decided to begin unwinding its massive equity ETF empire, a position worth 83.2 trillion yen, over 500 billion US dollars. In a phased manner, let that sink in. The largest buyer of Japanese stocks in history is preparing to step back and potentially become a seller into a market that is already losing liquidity. So today, the setup is materially worse than August. Japanese bond yields are 50 basis points higher. Leverage across global markets is still deeply embedded. And now, ETF selling is layered on top of rate hikes. This is not a replay. This is a sequel with thinner liquidity, bigger positions, and exponentially higher stakes. If this unwind starts, there will be no orderly exit, no warning bell, and no time to reposition. But there is a way through this. There's a way to protect capital and even profit from the chaos if you act before the crowd. So don't click away, because in this video, I'm going to break down what's coming, the exact signals to watch, and how to position before this liquidity trap snaps shut. This is the Smart Wealth Code, your compounding machine. Chapter 2. The yen carry trade, the engine behind the boom. Before we go any further, you need to understand one thing. This entire market cycle has been powered by a trade most investors never think about. The yen carry trade. Here's how it works. In plain English, for years, Japan kept interest rates near zero. That made the yen the cheapest funding currency in the world. So institutions did what institutions always do. They borrowed yen at virtually no cost, converted it into dollars or euros, and chased higher returns elsewhere. US stocks, big tech, emerging markets, private credit, crypto. This wasn't small money. This was hundreds of billions of dollars, quietly recycled through global markets. As long as the yen stayed weak and rates stayed low, the trade worked. But here's the catch. The moment the yen strengthens or rates rise, that trade becomes unprofitable. And when leverage is involved, unprofitable turns into forced selling. That's why this matters now. Chapter 3, the ETF unwind, removing the buyer of last resort. Now layer in the second shock. For over a decade, the Bank of Japan wasn't just a lender, it was the buyer of last resort in Japanese equities. Through its ETF purchases, the BOJ became a permanent bid under the stock market. That ETF empire now stands at 83.2 trillion yen, and the BOJ has made it clear. This position will not grow indefinitely. The plan is to begin unwinding slowly, quietly, carefully. But markets don't care about intentions, they care about flow. Even modest selling removes a structural support that investors have relied on for years. And remember, this is happening at the same time rate hikes are tightening funding conditions. So now you have higher borrowing costs and a disappearing buyer. That combination is how liquidity vacuums form. Chapter 4. Why the timing is dangerous. This is where everything converges. The Bank of Japan is not exiting from a position of strength. As yields rise, the BOJ is already sitting on over 32 trillion yen in bond losses. The 10-year Japanese government bond yield is pressing toward 2%, a level that stresses the entire system. And yet, policymakers are under pressure to tighten. Why? Because wage growth is holding near 3%. Inflation is hovering around 2%. Business sentiment surveys are at multi-decade highs. On paper, this justifies rate hikes. In reality, it creates a policy trap. If the BOJ hikes too slowly, inflation risks becoming entrenched. If it hikes too quickly, it risks detonating leverage across global markets. And here's what makes the timing especially dangerous. This is not happening during strong global growth. We're already seeing slowing demand, weakening labor signals in the US, declining commodity prices, and tightening financial conditions. That means the margin for error is extremely thin. History shows that policy mistakes don't happen during booms. They happen late in cycles, exactly like this. Chapter 5. Why Crypto is Flashing Red First. Now, let's talk about Bitcoin because it's sending a very clear warning. Every time the Bank of Japan has hiked rates, Bitcoin has fallen approximately 20%. Bitcoin is not just a speculative asset. It's the purest expression of global liquidity. When money is cheap and abundant, it explodes higher. When liquidity tightens, it rolls over first. That's exactly what we're seeing now. As yen funding becomes more expensive, leverage positions unwind, and crypto feels it immediately. This is why Bitcoin weakness often leads declines in tech stocks and risk assets. It's not coincidence, it's cause and effect. And historically, when crypto breaks down during a tightening cycle, broader markets follow. Chapter 6. The Signals You Must Watch Closely. This is where awareness turns into preparation. There are a few signals that matter far more than headlines. First, dollar to Japanese yen exchange rate. A sustained break below 153 tells you the carry trade is unwinding. Second, the yen exchange traded fund, FXY. It offers exposure to the Japanese yen relative to the US dollar, increasing in value when the yen strengthens and declining when the dollar appreciates. This fund could be appropriate for investors seeking to hedge exchange, rate exposure, or bet against a greenback. A move into the high 60s confirms real momentum, not noise. Third, Japanese bond yields. If the 10-year pushes decisively above 2%, pressure escalates rapidly, reducing the differential with the US interest rates. Fourth, Bitcoin. Continued weakness is not a crypto story. It's a liquidity story. When these signals align, markets don't drift lower. They reprice. Chapter 7. What a full unwind actually looks like. If this accelerates, here's what the Japanese unwind looks like in real terms. Equity markets don't collapse overnight, but they correct fast. 10 to 15% drawdowns become normal, not extreme. Nvidia and Palantir moves to 150. Bitcoin moves to $70,000. The yen strengthens aggressively, potentially toward 140 per dollar. Crypto sees another 20 to 30% decline as leverage exits. Emerging markets face capital outflows. Systematic and algorithmic funds amplify the move by selling into weakness. This isn't panic selling, it's mechanical selling, and that's what makes it so powerful. Chapter 8. How to profit from this shift. Now, here's the most important part. This is not a call to panic. This is a call to position intelligently. Every major volatility event creates two outcomes: losses for those who are overexposed and opportunity for those who prepared. The goal right now is threefold. First, reduce exposure to assets that depend on cheap liquidity, crowded tech, speculative growth, high price earning ratios, excessive leverage. Second, rotate into defensives and real assets that historically perform better during tightening cycles: utilities, healthcare, gold, silver, and short duration treasuries. Third, maintain liquidity, Cash and short-term instruments give you optionality when markets dislocate. This is how capital is preserved and compounded during turbulent periods. There is a way to navigate this smartly, and those who prepare now don't just survive, they emerge stronger. Volatility is not the enemy. Being unprepared is, and if you position ahead of the crowd, this period of stress can become one of your greatest wealth building opportunities. This is a smart wealth code, your compounding machine